This is a Solidus story. In 2008, the world watched as the entire financial system collapsed in real time. Banks that were too big to fail failed anyway. Millions lost their homes, their savings, their futures. But in the wreckage, someone saw an opportunity. A mysterious programmer began designing something the world had never seen: money that no government, no bank, no institution could control. This is the story of how crisis gave birth to revolution. September 15th, 2008. Lehman Brothers, a 158-year-old institution that survived the Civil War, 2 World Wars, and the Great Depression, filed for bankruptcy. It was the largest bankruptcy in American history. $600 billion vanished overnight. But Lehman was just the beginning. Within days, AIG collapsed. Merrill Lynch was forced into a fire sale. Washington Mutual failed. Wachovia teetered on the edge. The dominoes were falling, and nobody knew where it would stop. The people who were supposed to protect us, the experts who promised they had everything under control, suddenly admitted they had no idea what was happening. Federal Reserve Chairman Ben Bernanke stood before Congress and said that without immediate action, there might not be an economy on Monday. Think about that for a moment. The chairman of the Federal Reserve, the most powerful financial institution on earth, was essentially saying the system was hours away from total collapse. So the government stepped in. They injected $700 billion of taxpayer money into the banks that had caused the crisis, the same banks that had gambled with people's mortgages, that had created toxic assets nobody understood, that had paid their executives millions in bonuses while ordinary families lost everything. The message was clear. The banks were too big to fail. But the people? The people were small enough to lose it all. 9 million Americans lost their jobs. 10 million lost their homes. Retirement accounts that took decades to build evaporated in weeks. College funds disappeared. Small businesses shuttered. Entire communities were hollowed out. And while families stood in unemployment lines and moved into their cars, the bankers who engineered the collapse walked away with golden parachutes. The CEO of Lehman Brothers had made over $400 million in the years leading up to the bankruptcy. He kept most of it. The anger was visceral. Occupy Wall Street erupted in cities across the globe, but anger wasn't enough. The system had failed and everyone knew it, yet there seemed to be no alternative. Banks had always been the gatekeepers of money. If you wanted to save, to invest, to buy a home, to start a business, you needed them. And they knew it. They charged fees for everything. They decided who got loans and who didn't. They created money out of thin air through fractional reserve banking, lending out far more than they actually held. The 2008 crisis exposed something people had always suspected but never fully confronted. The entire financial system was built on trust, and that trust was a lie. Central banks could print unlimited money whenever they wanted. Governments could inflate currencies to pay their debts. Banks could gamble with your deposits and, when they lost, force you to bail them out. And you had no choice but to participate, because what else were you going to do? Bury cash in your backyard, trade in gold coins. The modern economy required banks, and banks required your faith in a system that had just proven itself unworthy. But someone was watching. Someone who understood that the problem wasn't just bad regulation or greedy bankers. The problem was centralization itself. The problem was that we had given a small group of people complete control over something that affected everyone: money. 3 months after Lehman Brothers collapsed on October 31st, 2008, a white paper appeared on an obscure cryptography mailing list. 9 pages. The title was simple: Bitcoin, a peer-to-peer electronic cash system. The author's name was Satoshi Nakamoto. Nobody knew who Satoshi Nakamoto was. Nobody knows to this day. But the ideas in those 9 pages were revolutionary. Satoshi proposed a form of money that didn't require banks, didn't require governments, didn't require trust in any central authority at all. Instead, it would run on mathematics and code. A network of computers around the world would verify every transaction. No single person or institution would control it, and the supply would be fixed, absolutely limited to 21 million units. No printing more when it was politically convenient. No inflation to secretly tax savers. Just pure mathematical scarcity. It seemed impossible. Money had always required someone in charge. Kings minted coins. Governments printed dollars. Banks kept the ledgers. How could money exist without someone controlling it? Satoshi's answer was brilliant and deceptively simple. The ledger itself would be public. Every transaction from the beginning of time would be recorded in a chain of blocks, each one cryptographically linked to the last. Anyone could see it. Everyone would have a copy. And to change it, you'd need to control more computing power than the rest of the network combined. They called it the blockchain. On January 3, 2009, Satoshi mined the first Bitcoin block. Embedded in the code was a message, a timestamp pulled from that day's London Times headline: Chancellor on brink of second bailout for banks. It wasn't subtle. This was a direct response to the financial crisis. A middle finger to the system that had failed, a declaration that there was another way. For the first year, Bitcoin was worth essentially nothing. A few cryptography enthusiasts and libertarians played with it, mining coins on their laptops, sending them back and forth as an experiment. Most people had never heard of it. Then in May 2010, a programmer in Florida bought 2 pizzas for 10,000 Bitcoins. It was the first real-world transaction. Those pizzas at today's prices would be worth hundreds of millions of dollars. Slowly, quietly, Bitcoin began to grow. Not because governments promoted it, not because banks invested in it, but because individuals saw what Satoshi saw. The system was broken, and here was an alternative. But Bitcoin wasn't just a reaction to 2008. It was a fundamental reimagining of what money could be. For thousands of years, money had been whatever authority said it was. Shells, beads, gold, paper, digital entries in bank databases. Its value came from force, from law, from the threat of violence if you didn't accept it. Bitcoin proposed something different. Voluntary money. Money that existed because people chose to use it, not because they were compelled to. Money that couldn't be seized by governments or frozen by banks. Money that you truly owned, as long as you controlled the private keys. It was a return to something ancient and a leap into something entirely new. Of course, the establishment dismissed it. Nobel Prize-winning economists called it a bubble, a scam, rat poison. Bankers laughed. Regulators warned. How could magic internet money created by an anonymous person possibly compete with the dollar, backed by the full faith and credit of the United States government? But they were missing the point. The full faith and credit of institutions was exactly what had been destroyed in 2008. People didn't want more promises from authorities. They wanted an alternative. By 2013, Bitcoin's price had reached over $1,000. By 2017, $20,000. The world was paying attention now. Some saw it as digital gold, a hedge against inflation and financial instability. Others saw it as the foundation for an entirely new financial system, one where individuals controlled their own wealth without intermediaries. Governments began to take notice too. Some banned it, others tried to regulate it, a few even began to adopt it. El Salvador made Bitcoin legal tender in 2021, the first country to do so. The debate raged. Was Bitcoin the future of money or a speculative mania? A tool for freedom or a vehicle for criminals? A revolutionary technology or a wasteful energy sink? But beneath the volatility and the hype, something profound had shifted. For the first time in modern history, there was an alternative to the traditional banking system that actually worked. You could store value, send payments, and participate in an economy without asking permission from any bank or government. The genie was out of the bottle. Today, 15 years after Satoshi mined that first block, Bitcoin has survived everything thrown at it. Government bans, exchange collapses, brutal bear markets, endless declarations of its death. And yet it persists. A $60 trillion asset class has emerged around cryptocurrencies and blockchain technology. Major financial institutions that once mocked Bitcoin now offer it to clients. Countries explore central bank digital currencies, inadvertently validating the concept Satoshi pioneered. The 2008 financial crisis revealed that the emperor had no clothes. The system we trusted was fragile, corrupt, and designed to benefit the few at the expense of the many. Bitcoin was the response, not a perfect solution, not a panacea, but a proof of concept that money could exist outside the control of banks and governments, that individuals could reclaim sovereignty over their wealth. Whether Bitcoin itself ultimately succeeds or fails, the idea it represents cannot be undestroyed. The idea that we have a choice, that we don't have to accept a system that repeatedly fails us, because in the end money is just an agreement, a shared belief in value, and agreements can change. The crisis of 2008 shattered one agreement, and in its ashes, Satoshi Nakamoto planted the seeds of another.